proven to be a good asset to own during periods of elevated geopolitical risk. And gold has actually been going higher since the day after the Hamas attacks. If you look at the market, we declined from May, late May last year, right to October 6th, as the Fed, as it became clear we were not going into a recession, and the Fed was not going to cut rates, and we came out of the debt fiasco, and the bank stress situation eased. The gold market dropped right up until those attacks, and I'm not blaming it all on that, but if you look at that and geopolitical incidents around the world, it makes it likely that not only would a central bank buy, but others will buy as well.
You're making the sort of central bank a lot less dramatic than a lot of people who come on who say they are concerned about the sanctions that the U.S. put on certain places, including Russia and China. This is a concern for them, and that this is going to continue, and that there's a lot of legs here for central bank buying. Are you pushing back on that and saying this is on the margins? They filled their coffers with dollars, and they're just sort of rejiggering things, and it's pretty much done?
No, but I'm trying to find some moderate level in between. Central banks are major buyers, and they're buying it at least double the rate of the average of the last 15 years. 2022, almost 1 out of every 3 or 2 out of every 5, 1 out of every 3 ounces of gold that was mined ended up in a central bank. So that's enormous. That's almost 1,100 tons. The year before that, it was more like 450 tons. Last year, I think it was 1,037 tons. We're looking for more like 800 tons this year, but that's still well above the level. So we're just saying maybe not as high in the last couple of years, but higher than we've seen historically. But I think what many of your other commentators are pointing to, and I would agree, once central banks start on a policy course, it's usually multi-year. When they sold gold, by the way, and I remember when they did, my hair was gold at that time, by the way.
That potentially we will see more of that in terms of the sanction policies coming out of the United States?
Well, Barry Eichengreen, I believe, and I'm almost sure it was him, that in a paper that he wrote, said that the threat of U.S. sanctions would be an inducement for some central banks to buy gold. And that would obviously...
Would you categorize as de-dollarization, though, or is that too harsh?
I think it's slightly too harsh. I mean, at HSBC, we're certainly in the camp that the dollar will remain the world's reserve currency for the foreseeable future, for a whole range of reasons. But the point I think to make is that's not to say that they need as many dollars as they have now. So the point being, interesting. U.S. dollar is 59% of foreign exchange reserves. It's down from in the 60s a number of years ago. You don't have to go into another currency. You could go into gold, and that's what many of them are choosing.
James, this was great. I think you've reminded a lot of Brits at home of the brown bottom in the late 90s. Remember when he sold all the gold? Bad times. James Steele of HSBC. James, thank you, sir. It's good to see you.
Thank you.
Let's give you an update on inflation, because we need to be talking about that in 6 minutes' time. CPI drops. Mike McKee is in Washington, D.C. to break down that number for you. Mike, what are you looking for?
Well, we're looking for continued disinflation on a short-term basis, with both the monthly headline and core dropping a little bit, but because of energy prices and base effects, the year-over-year number for the CPI headline is expected to rise up to 3.4% from 3.2%. That would be a disappointment to some, but the quantity, because it's going to tell us something about what the Fed is thinking as it goes into May and then into June. A rise probably means June may be off the table. A drop, maybe it comes on.
Mike, just real quick here, how high is the threshold to really shift the Fed, given the fact that we have gotten a number of hotter than expected inflation reads over the past few weeks?
Well, I think if the number goes up significantly, then it really does have an impact, and you'll see a big market trade on it. But CPI doesn't usually come in. It can surprise, but when it does, it's by a tenth. And a lot of that now is down to rounding. Everybody's looking at 3 decimal places on the CPI numbers, so it's going to take a lot for something like that to happen.
Mike, sit tight. Stay close. The inflation data, 4 minutes and about 25 seconds away. We'll catch up with Mizuho's Steve Rasciuto, JP Morgan's David Kelly. Those two reacting to the numbers as Minor Key breaks it all down for you. The scores look like this on the S&P 500, positive by 0.1%. Yields come in a little bit lower, down a single basis point. The 10-year, 435. The 2-year, 473. Inflation data up next.